causing decrease in the value of their stock market and bond market, and causing more panic to the currency market as well, because they are selling their euro and converting their currency into their home currency. So because this was just one country, but its currency is opted by many other countries, all the eurozone. So this triggered, or this crisis spread all on the Europe. So whoever owns a shares or stock, even in Germany, because the anticipated decrease in euro, it would not be feasible to keep that security. They just sell that and take out the money back. Means they are creating huge supplies of euros. So investors who own euro denominated securities attempted to liquidate, which means sell. Liquidate means sell their position and sell their euros before the currency value decline. So these conditions were partially responsible for 20% decline in the value of the euro during spring 2010. The reality was different. The Greece does not, abandon euro. Still in Greece, the currency is euro. But due to this anticipation, what happened? In advance, the value of the currency started declining. How much? 20%. Right? So here, so all these factors that causes changes in exchange rate, we can categorize this in terms of trade related factors and financial factors. Some factors, they place upward pressure on the currency, and some place downward pressure. Let's talk about that. So trade related factors, we call that inflation, income, and government controls. We call those factors trade related factors. Financial factors, they are called interest related factors and capital flow restrictions. Right? So what happened here? If trade related factors, they also affect the goods market, or also will affect your balance of payment account of the current account, right? Current account in your balance of payment. Sorry, in current account and the balance of payment in exports minus imports, right? The major part of this current account is balance of payment, which deals with the difference between exports and imports. So trade related factors, which is inflation, income differential, and government controls, they also affect not only the goods market, also affect the currency market as well, right? While the financial factors, they don't affect much of the current account, but they do affect the financial markets, demand for stocks and demands for bonds, right? So by affecting demands for stocks and securities, through then they affect the currency, right? So if inflation rises, that doesn't mean that people are are more interested to buy stocks. It means people are more interested to buy foreign goods. If income rises, people are more interested to buy foreign goods. If government restrictions are lessen, or if government lose their trade restrictions, then what happened? People want to buy more trade related goods rather than investing in stock exchange or financial products, right? So these three factors are called trade related factors, and these two, capital flow restrictions and interest rate differential, these are called financial factors that affect the exchange rate. So that's a summary. And the last point of our discussion of today's LOS, which is learning objective statement, was movements in cross exchange rates. So the crux of this discussion is that if currency A and B move in same direction, then there's going to be no effect in cross exchange rate. If there is dollar, pound, and euro, if dollar is increasing and also pound is increasing, then there's going to be no change in the cross exchange rate. Both will be also uh, because nullifying their effect. What happened here? The next one. When currency A appreciate against the dollar by greater degree than the currency B, then currency A appreciate against B. So here, what it wants to say there are three currencies here. One is dollar, which is your home currency, and there is A currency and B. If A appreciate greater than B, right? Again, there are three currencies and this is your home currency. If A appreciates dollar and B appreciate less than this dollar, then A also appreciate against B, because A magnitude of the the appreciation is greater than B magnitude. So A will also appreciate greater than B. These are just a tidbits, just a hints, so you can understand that, okay, through graph or through expectation or whatsoever, it will give you a quick decision. Okay, if A is increasing the dollar greater amount than the B, then we already know that if we make a cross exchange rate between A and B, A will be appreciating. The third one is when currency A appreciate against dollar while currency B is unchanged, it means A is also appreciating against B, because A appreciate and B remain unchanged. Then when you make a cross exchange rate, A appreciate against B as well. So if you see the graph here, so this is the British pound, this is the euro. So you see the British pound, this is pound over euro, a pound over euro. And this is euro against dollar, this is euro against dollar. You see the value of euro decrease and then start rising and then decrease. And here, this is the value of British pound against dollar. It depreciated and start in appreciating and then depreciated. So, and this is the cross exchange rate, which is always in the middle. You see that so this is the value of euro in pounds. So euro was depreciating, and you see against pound, it is appreciating at the end and then depreciating and then remain constant. Why? In this case, both currencies are depreciating, so cross exchange rate would be no change. In this case, let me just clear. In this case, when euro is appreciating, in this case, when pound is also depreciating and euro is also depreciating, you see there is no change in cross exchange rate. And here, in this scenario, when pound is depreciating and euro is appreciating, right? But there is a greater amount. Pound is depreciating by 2 and euro is depreciating, euro is even appreciating by lower amount. So greater event caused by that currency who is depreciating with more points, with more magnitude. So you see the cross exchange rate is declining here, even though here the euro is still increasing here, but the pound is decreasing. The magnitude here is 2 and the magnitude is here is 1.4 or something. So it means the currency who experience greater appreciation against, for example, here the home currency is dollar, then A will be, the effect going to be on other currency going to be larger by that who is appreciating or depreciating. So this is just the end results, what we just talked about. So institutional speculation, which means it is not done by individual, it's by banks, some companies, like big institutions. If they speculate based on appreciation, which means in future the currency going to be rise. So what happened? When the financial institution believe that the currency is valued lower than it should be in the foreign exchange market, they may invest in that currency before it appreciate. Simple logic is that. If you see in future the product price going to rise, you will buy right now, so that when it start rising or it rose on the optimal level, you sell that one. So if the financial institution believe that, if financial institution believe that the currency is valued higher right now, if it is overvalued right now, they may borrow the funds in the currency and convert it into their local currency now before the currency value depreciate to its proper level. What does it mean? It means if you know that your currency is going to be decreasing in future, right? So you will be asking, it means your currency going to depreciate, mean foreign currency going to rise, right? So you will buy other currency and invest in right now, so that if your currency depreciate, the foreign currency will appreciate, and when you convert back to your home currency, you will receive more home currency. Simple as that. And carry trade is a concept when everything is, if everything is equal, then investor attempt to capitalize, which means making profit just on base of interest rates. If inflation is same between two countries, income level is same between two countries, and if interest rate is higher in one country, then capital flow will move to that country where interest rate is higher. When they convert back to their home currency, they will receive two gains. One is the interest, the other one is the increase in currency as well, the currency gain as well. So that's all for this chapter, and this is just a summary, so you just read it by yourself. So I'm just going to talk about something on our midterm. So I have decided your midterm is going to be November on our coming classes. So the next class, we are not having our midterm. So midterm is going to be on November, I think on 3rd of November. Thursday, right? So I'm not sure, but the exact date.
The next Thursday, the first Thursday in November will be day 5.
5th or 3rd?
Yeah, November 5. Yeah,
Yes.
November 5.
Okay,
November 5.
November 5th. So we will talk about the paper pattern and all those stuff, the composition of this, exam on our next class. Okay. So I'm going to be sending out
Yes.
these PPTs, and also a very short assignment, not a big assignment. So assignment 3, and it's going to be due on our next lecture.